I'm Colin Singer, immigration lawyer and managing partner of Immigration.ca. Canada Immigration News Articles, April 2015. A robust U.S. economy will ensure that slow growth will not be Canada's new normal. A number of factors are restraining the trend of growth in Canada, including the lingering impact of the 2008 financial crisis, an aging population, and even a slowdown in the underlying rate of innovation and technological change. According to a paper released last month by the Fraser Institute, there is reason to believe that pessimism about growth will prove to be an overreaction to the current economic environment, just as occurred in the 1930s and the 1970s. These past periods of prolonged slow growth ended when governments adopted better and more predictable economic policies. As the price of oil continues to fall and the lingering effects of the financial crisis dissipates, the U.S. economy is slowly improving. The United States seems poised to return to above-trend rates of growth, as shown by a string of strong employment reports. In Canada, both gross domestic product and employment surprised to the upside in the last month, even as a majority of Canadians say they think the economy is in decline. The last time a slumping resource sector and robust growth in the United States occurred simultaneously was in 1998, when growth in Canada accelerated. This implies that a stronger U.S. economy can trump lower commodity prices. The importance of our resource sector has increased since then, and this will dampen growth somewhat, but the impact will be less for the real economy than for the stock market, which appears to be driving the public's perception of how much difficulty the economy is in. An aging labor force is much more of a problem for Europe and Japan than North America, which has a younger population that is not projected to contract in the future due to high immigration. The possibilities for innovative technological change remain encouraging for growth, although this variable is the most difficult to project. In Canada, growth since the recession has not been unusually weak compared with the previous 2 decades. Last year's real GDP growth of 2.5% exceeded its 25-year average, and this was reflected in the historically low level of adult unemployment of 5.5%. Canada is well positioned to take advantage of an upturn in the U.S. economy, since the lingering effect of the recession in the financial sector and labor markets was much less pronounced than in the United States. This will help Canada overcome the slump in commodity prices. A further boost to growth would come from a better policy framework, especially in central Canada, where provincial government debt continues to increase. More policy stimulus, such as the Bank of Canada's interest rate cut earlier this year, is not needed in North America at this time, and growth would be better served by more predictable economic policies. Source: The Globe and Mail.